Hey, what's going on, guys? Real estate and the economy is not looking good. I don't care how many people want to tell me it's doing good because people are still buying Taylor Swift and Beyonce concert tickets. It's not, and the data shows it's not, and I have a lot to show you. Firstly, here from Darth Powell. Just a reminder, your home was worth $462,000 at 2.7% mortgage rates is worth $280K at 7% mortgage rates. And if you look at here on the graph, it kind of illustrates that. That's not quite a 50% decline, but maybe like 40% or so. And median sales are coming down. If you look at the Fred, median sales price for houses sold, the last registered quarter was Q2 of this year, down from a peak of 479, let's just call it 480, down to 415. So it has tumbled maybe, what is that, like 15, 20% so far? However, if you put the median sales price for all houses sold in the United States in terms of real median household income, a property right now, this is up to 2021. So they've either just haven't updated this or not. But if you go back and look at the median house prices here in 2021, in Q3, Q4, it was $423,000 there. And right now we're at $416,000. So we have had a little bit of wage growth, but nonetheless, this is still pretty accurate for this year. And as you can see, back in 2006, it was an index of 3.75, and right now we're at 5.6. So what is that, about 1.5 times more expensive than right during the bubble, right before the 2008 great financial crisis. We've also got this yield curve inversion, which looks, look at how deep this is. I don't know if that necessarily means that the recession, when it comes, is going to be if it's going to be worse, right? Because you had it didn't dip as deep during right before 2008 or so. And this is just massive, right? And this is not a good sign. This is predicted almost every single recession. Down here, it inverted. And then I guess you could say even this one too, if you consider this the inversion leading into these two recessions. And even if you look at the difference between the 10-year and the 3-month inversion, look at this over the different recessions. You've got July, this is July in the black here, right? And this is when it first inverted. The green line, we're looking at 2006, so it headed up. We still got maybe, what is this, 8 more months until potentially a massive crash. And none of this is financial advice or anything like that, right? I just like to monitor the housing market. If you want to flip houses or wholesale real estate, you want to stay on this stuff. But looking at that, and then you've got all these other ones, right? They usually head up first before they head down. These ones, not necessarily, but we do have some indicators that could be happening here. We are starting to see the yield curve come back towards this, break-even bound here, but not in the way we want. If you look at this data, the 10-year is up 23, the 20-year is up 27 basis points, and the 30-year up 30 basis points. So the short end of the yield curve is still going up, but the back end of the yield curve, those longer maturity, bonds, those are going up. So we might get an inversion and that might mean all the rates are going to be higher. And this is not good, right? Because all this points to is potentially higher for longer. And I just do not see real estate being able to maintain these interest rate levels. A lot of people are buying houses right now with the idea that, well, you can refinance your house once they cut rates. But what if they cut rates and, pre-election? Like right here, we've got the probabilities from the CME, right? This is what it looks like might happen. They might start cutting rates leading into the next election. But then after that, we might see inflation spike back up. They may not have killed inflation, and these rates might have to come back up after the election. And the biggest cause of this would probably be the deficit spending. The government has to keep on printing and printing money to make up for its deficits. All that goes out into the economy, or at least a lot of it, and that is going to push inflation back up. Tax receipts are so low this year that they're going to have to print the difference. And this is just anecdotal, but I was talking with a realtor at the gym the other day, and he was saying, nah, man, we're not going to have any recession. They're about to start cutting rates. Prices are going to, go back to going up. It's not going to be that big of a deal. And one thing he said was, we already had a recession, which I pushed back on. I do not think that we have already had the recession. And if you look at these unemployment numbers, they do not illustrate a recession. Usually when there's a recession, the employment rate spikes up. Here, after the dot-com bubble, it made it to 6%. And after the great financial crisis, it made it up to just barely double digits. So let's say it were to go between 6 and 10%. Right now, if you just ignore this, the lockdowns that we had in 2020, it looks like we're still on the low unemployment trajectory as if this whole thing never even happened. So we haven't even had recession type unemployment yet. And I personally, this is just my opinion, I do not think that rates are going to come down until we start seeing the unemployment rate reach 6 to 8%. Just my opinion on that. What are your guys' thoughts on the unemployment rate? Do you think that it's going to have to get that high before Jay Powell starts to cut the rates? And the reason for that is if everyone has money in their pockets, they can go out and spend money, which is going to keep inflation running hot, which again just means higher rates for longer. So in my opinion, they need to kind of squash jobs. And where are people really getting the money from to spend right now? U.S. adults, this from Bankrate, U.S. adults with more credit card debt than total savings keeps on increasing just from 2021, 21% all the way up to 36%. And I imagine it is only going to continue getting worse and worse. And it really doesn't make any sense, right? It's a bit of a head scratcher. Why are people going into credit card debt if we have such a healthy job market and low unemployment? Something is going to have to give. U.S. corporate bankruptcy filings year to date were the highest in June since 2010. If you look at, this is the first 6 months in this like turquoise color here, and then gray is going to be the rest of the year. So at 340, yeah, this is the most since 2010 when we were going through the great financial crisis. So we're going to have to see what the second half of this year has in store for us. But by some predictions, it could be way worse than we're seeing right now. To bring it specific to real estate, I just did an Airbnb bust video a couple weeks ago, and they're starting to see a lot of vacancies for these Airbnb. So they're either going to have to turn them into long-term rentals, or they're going to have to put these houses on the market, which is only going to further drop the value of houses, right? But the interest rates are going to be high. So they're going to have to drop the price. And I've got some other data to show you here because there's also a lot of houses being built right now. But this is the vacancies, which are going up, which, it hasn't been this high in a minute. And here are the specifics of these average vacancy rates. It looks like Ogden, Utah, Colorado Springs, San Antonio. You can take a look here, see if some of your places. I was wholesaling in Las Vegas, Nevada, back a few years ago. So they're starting to come down, probably from everyone moving from California to Las Vegas. I know rent skyrocketed there, so it's due for a rebound. And that is also just something to keep in mind. As more houses hit the market, as these Airbnbs hit the market, rent rates with these vacancies are going to they're going to have some downward pressure on them. So we've got here new privately owned housing units under construction. Look at this. We have the most houses being built right now than any time in recorded history, right? Even going back to 1973 is when this was tracked. It's even higher than that. So we've got that. We've also got demographics, which I don't have data pulled up for, but you're going to have a lot of older folks that are going to be passing on their houses to, their kids and whatnot. And those kids are probably going to be liquidating or selling those houses. So you've got demographics with people that are going to be, passing away, and they're going to have those houses hit the market, new houses like this. And then you've also got these Airbnb investors and speculators, even rental houses that are probably going to hit the market because they're not going to be able to get the rents that they thought they were going to get. And the rent deflation is here, and you can see that from this chart. It's the U.S. rent index is in a dark blue, which is sort of just, clumped into this here. It's if it's not negative, it's close to negative. California, New York, Texas, and Florida are experiencing it. But again, it does look like the entire U.S. is having some rent deflation going on. And lastly, I want to talk about oil because the price of energy has an impact on everything that we buy. And it's a reason why inflation might rear its ugly head in the future. Right now, the current administration has been just draining the strategic oil reserve to keep the gas prices down, but we are running out. That needs to be refilled. And the oil price right now is $81, but I could easily see it going up to over $100 again. And eventually, we are going to have to fill that back up, and this is going to cause more inflation. If you're still here and you like the video, don't forget to hit the like button, subscribe, hit the notification bell for more content like this in the future, and I'll see you on the next video.